Hello everyone, I am Zahra Fatima. Welcome to my channel. Students, today in this video I am going to explain you the subject financial management. The subject financial management is having by the students of BBA students, MBA students, MCom regular as well as distance students, and CA students also having the subject financial management. And this is my fifth lecture on the subject financial management. In my last last three lectures, I explained you the first unit, that is the finance function, and in my fourth lecture, I explained you the unit 2, that is investment decisions, that is also known as capital budgeting. And this is my fifth lecture on the unit 2, long-term investment decision, that is capital budgeting techniques. So students, if you are coming first time to my channel, I suggest you to see my first 4 lectures on the subject financial management, so that it helps to you to understand the problems easily, because problematic part is based on theoretical part. So once you understand the basics of the chapter, then it will be easy for you to understand the problems. So in this video, I am going to explain you the problems on capital budgeting. So students, capital budgeting is a technique for long-term investment decisions. So under capital budgeting technique, we have two methods, traditional techniques and we have modern techniques. Under traditional techniques, we have payback period, PVP, and average rate of return, accounting rate of return, ARR. And in modern techniques, we have profitability index, net present value method, and internal rate of return, IRR. So in this video, I am going to explain you the traditional technique, and under traditional technique, the first one is payback period. So in this video, I am going to explain you the problems of payback period method. So let's see what are the problems of payback period. So payback period means it is a period in which we can recover our initial investment. In how many years we can recover our initial investment from the generated cash inflows. So here two questions I am taking, and these two questions are very important from your examination point of view. Now the first question is, a project requires an initial investment of rupees 20,000 with a useful life of 5 years. The projected cash inflows CFAT for each year are as follows. Here years are mentioned from 1 to 5 years. The project life is 5 years, and CFAT for first year it is 8,000. For second year also it is 8,000. Third year also 8,000. Fourth year also 8,000. And fifth year also it is 8,000. And he is asking you to calculate the payback period. So students, in this question, he is asking you to calculate the payback period. Only he is asking you to calculate the payback period. So in the question, in the information it is given the initial investment. Initial investment means outlay of the investment. So in this problem, the initial investment, the outlay of the project is 20,000, and the returns, CFAT, cash inflows, is given first year to fifth year 8,000. Here every year the cash inflows are similar, cash inflows are uniform. So when cash inflows, in the problem directly cash inflows, CFAT is given. For calculating the payback period, we need the CFAT, and CFAT is given in the question. And here the CFAT is constant. Every year we have the same CFAT. So when cash inflows are constant, we can calculate payback period by applying the formula. The formula is payback period is equal to initial investment divided by constant annual cash inflows. So this is the formula. So when we apply formula, when cash inflows are uniform, when cash inflows are constant, in that case we apply the formula for calculating the payback period. Now let's see. Payback period. Payback period is equal to initial investment divided by constant annual cash inflows. Cash inflows nothing but CFAT. So here the initial investment, the outlay of the project is 20,000. So initial investment 20,000 and CFAT, constant cash inflows every year is 8,000. So 20,000 divided by 8,000. So we get 2.5. So this 2.5 years is our payback period. This is the payback period, PBP. So we apply the formula when cash inflows are constant, when cash inflows are uniform. So in that case we apply the formula initial investment divided by constant annual cash inflows. So this is the first question. Now the next question is calculate the payback period for the following projects, each requiring a cash outlay of 1 lakh. So every project required a cash outlay of rupees 1 lakh. Suggest which project is acceptable under payback period method. Here three projects are given and he is asking you to calculate payback period and suggest which project is acceptable. Now here years are given, 5 years. Project A cash inflows are given 30,000 every year. For project A the cash inflows are uniform, cash inflows are constant from first year to 5th year. Now for project B the cash inflows are 30,000 first year, 40,000, 20,000, 10,000 and 5,000. Here for project B, the cash inflows are not same. The cash inflows are not uniform. It is different. Every year we have different cash inflows. Now for project C, the first year cash inflows are 10,000, second year 20,000, third year 30,000, fourth year 40,000. Here cash inflows we have till 4th year. So total 3 projects are given and he is asking you to calculate the payback period for each project and suggests which project is acceptable under payback period method. Now the first project, for the first project cash inflows are constant. So when cash inflows are constant we can calculate payback period by applying the formula initial investment divided by constant annual cash inflows. Now here I am showing you project A payback period, initial investment divided by constant annual cash inflows. Now for project 1 the initial investment is 1 lakh and every year the cash inflows are 30,000. So constant annual cash inflow 30,000. So 1 lakh divided by 30,000. So if we divide 1 lakh with 30,000 we get 3.33 years. So this is our payback period for project 1, project A. Payback period for project A by applying the formula initial investment by constant annual cash inflows, because the cash inflows are uniform, the cash inflows are same every year. So we applied the formula initial investment by constant annual cash inflows. Now come to the next project, project B. Here in case of project B and project C, the cash inflows are not uniform, the cash inflows are not same, it is uneven. So in that case we have to cumulate the cash inflows. So here 3 columns, first column is year, second column is cash inflows, third column is cumulative cash inflows. So project B, calculation of payback period. Under that first is year, second column is cash inflows, third column is cumulative cash inflows. Now year 1 to 5. Now cash inflows of project B. For project B, the cash inflow first year 30,000, second year 40,000, third year 20,000, fourth year 10,000, fifth year it is 5,000. Now what we have to do? We have to cumulate the cash inflows. Now next column, cumulative cash inflows. First year the cash inflows is 30,000, 30,000 plus 40,000, 70,000. 70 plus 20, 80,000. Sorry, it's 90,000. 90,000. Then 90,000 plus 10,000, it will be 1 lakh. Then 1 lakh plus 5,000, 1 lakh 5,000. So the cumulative cash inflows of project A, project B is 30,000, 70,000, 90,000, 1 lakh and 1 lakh 5,000. Now our initial investment is 1 lakh. Now we have to see in cumulative cash inflows where our initial investment is arising. So our initial investment is 1 lakh and cumulative cash inflows in fourth year is 1 lakh. Exactly 1 lakh in fourth year. So the payback period for project B is 4 years. Because in fourth year exactly we are getting 1 lakh rupees, our initial investment. Now next project C. For project C, the cash inflow first year is 10,000, 20,000, 30,000 and 40,000. Again here cash inflows are not same, it is uneven. So again we have to cumulate the cash inflows. So again 3 columns for project C. First column year, second column cash inflows, third column cumulative cash inflows. Now cash inflows of project A, project C, 10,000 first year, second year 20,000, third year 30,000, fourth year 40,000. Now cumulative cash inflows. Now first year 10,000, 10,000 plus 20,000, it will be 30,000. 30,000 plus 30,000, so it will be 60,000. Then 60,000 plus 40,000, 60,000 plus 40,000, it will be 1 lakh. So for project C, the cumulative cash inflows in fourth year is exactly 1 lakh, which is equal to our initial investment. So in fourth year, the cumulative cash inflows are equal to our investment. So 4 year is our payback period. So payback period for project C is 4 years. In this way, we calculate the payback period. So payback period for project A is 3.33 years. And for project B is 4 years. And project C is also 4 years. Now he is asking you to suggest which project is acceptable under payback period method. So for project A, the payback period is 3.33 years. For project B, it is 4 years. For project C, again it is 4 years. So in case of payback period, we have to select those projects whose payback period are lesser. So here for project A is 3.33, for B is 4 years and for C is also 4 years. So whose payback period is lesser compared to B and C? Project A payback period is lesser, that is 3.3 years. So here project A is acceptable. So students, this is the problems of payback period. In my next video, I will show you how to calculate average rate of return or accounting rate of return. Later on I will explain you net present value method, internal rate of return and profitability index. Now I hope all of you understand now the concept of payback period. How to calculate payback period when cash inflows are constant and when cash inflows are not constant. So students, like and share this video with all your friends, and if you are coming first time to my channel, please subscribe the channel so that future notifications related to my future videos will come to you directly. And students, inform your friends about the channel, about the videos and about the upcoming videos also, so that it helps to you and your friends for the preparation of your upcoming examination. So students, stay connected with us. Thanks for watching the video.